Hi all, we are in the economy video module and we will be looking at the next immediate chapter, that is financial markets. Financial markets is a very important chapter from the perspective of any examination because it will cover the basic money market instruments and capital market instruments, what they are all and all we will see in this chapter. From exam point of view, it is very important chapter, including with money and banking. At the same time, one more chapter along with financial markets that is more important is money and banking. That is next immediate chapter that we will be looking into. So let us have a look at financial markets. Financial markets is the place where the financial transactions take place. It is financial markets. They are basically two types. One is money market, the second one is capital market. So you can differentiate both of them using the name itself, that is money. This is more liquid. This is the market where the money is exchanged, the cash is exchanged. That is for overnight to 1 year. That is the time period for money markets. And capital. So this is about the capital market. It is more in the form of assets, not direct liquid cash. That is money market is more liquid market, while capital market is assets, and it is generally for period more than 1 year. These are the two types of financial markets that we will be looking into in this chapter. First one is money market. It is the market for the immediate liquidity or cash. See, everybody in the economy will have a requirement of money or cash to carry on their daily requirements, businesses, commerce, trade, manufacturing, or anything for that matter. So everybody will have those liquidity requirements on day-to-day basis. It is not just individuals, it will be financial institutions like banks, other NBFCs and other financial institutions which will be dealing with the money. They may be dealing with the refinancing or borrowing and lending like banks. They also need liquidity on day-to-day basis. Next, it is generally from overnight to 1 year. The lending and borrowing of liquidity or cash or money in the financial markets, which happens from overnight, that is from less than 12 hours to 1 year, up to 1 year, can be categorized under money market, that is liquidity market. So there will be instruments actually. There are various instruments which are being used regularly in the financial markets under their own headings, like money market instruments. There are few such instruments in money market which are utilized in the financial markets to do the financial transactions excuse me, to ensure the financial transactions. A few instruments are being used. We will be looking into those instruments. Currently we are in the money market and we will be looking into the money market instruments. First such money market instrument is call money or notice money. Easy. Call money means overnight to 1 day. Notice money means 1 day to 14 days. If the borrowing and lending of money in the markets or the financial transactions take place from overnight to 1 day, it is call money market. If it is 1 to 14 days, it is notice money market. It is generally a interbank phenomena. It is not observable to individuals in the economy because for individuals they don't give on overnight basis or for 1 to 14 days. It is given by banks in other duration and other terms. This is interbank, when the banks or the financial institutions need money to carry on their day-to-day businesses, borrowing and lending requirements and everything. In order to do that, banks will borrow and lend. That is, if they do it from overnight to 1 day, it is call money. If it is 1 to 14 days, it is notice money. This is essentially interbank. Who gives money to the bank? That is RBI, the Central Bank of India. The central authority for banking and money and financial systems is Reserve Bank of India. Reserve Bank of India will give money to the banks, or they can also lend and borrow from other banks also. So it is essentially a interbank phenomena or interbank concept. So generally not observable to the individuals. There may be a very easy question on this as to differentiating what is call money and notice money, or regarding this interbank or anything which can be easily trickily asked in these concepts. Second one is bills market. Bills market is the next market, and there are few instruments within this. That is, the first one is T-bills, that is Treasury Bills or Government Securities, GSEC. And second one is commercial bills. So these are the instruments under bills market. T-bills or government securities are issued by government. This is by private companies or any other individuals or any other companies, because it is commercial. There will be a trading goods that is in between that creates the value for this bill. We'll exactly look at what these bills are and how they can be utilized on a day-to-day basis in the financial markets. So let us take T-bill. It is basically a treasury bill. Means what will happen is, when the government needs money to run their day-to-day businesses, to fulfill their day-to-day requirements and anything, if they need money, what they will do is they will try to get it from the public itself. How? By issuing treasury bills. Say suppose there is a T-bill worth rupees 10,000. That government is ready to issue and I am there who is ready to buy. So I'll buy this bill and I'll be paying some amount like 9,100. Then it will be written that in 6 months the government will pay me 10,000 if I give back this T-bill to the issuing authority. That is RBI. Who issues T-bills or GSEC on behalf of government? That is Reserve Bank of India. So after 6 months, if I go and give this T-bill to the RBI, it will give me 10,000. This concept is called discounted bill. This is a little technical thing, that bill will not be sold at 10,000 and after 6 months they will not pay 10,850 or something as an interest, but they will sell it at 9,100. Then after 6 months, including the interest, finally they will pay 10,000. This is called face value of the T-bill. Who issues? RBI. So what I will pay this much amount to the government, government will issue me T-bill. There is a validity of 6 months for it. So what happens after taking this T-bill? Within these 6 months, within 3 months, I had a requirement of 10,000 rupees. I need it in liquid form or cash form. So what I will do, I will go and trade this bill or give it to the banks. In exchange for that, I will get around say 9,500 or 9,600, whatever it is, I will take it, because 0 or 9,500. When you need liquid money, what you will do, you will be even ready to lose that 500 because you wanted 3 months early. That's why you may be ready to sell it at 9.5, 9.4, whatever it is. It is better than having no liquidity at all. So then I will try to convert it into liquidity or cash. These are accepted by banks. These are all tradable in the markets also, that is in the capital markets, that we will see This can be traded over in that platform. Somebody is ready to buy it at 9,400. If I want liquidity before the expiry of this 6 months, I need cash, I will use this as an instrument. So it is an instrument through which the money will be flowing in the financial markets. It is also controlled by RBI. These are government issued. This bill is paid from the treasury of the government. That is why these are most secured instruments, because government is ensuring, and lowest risk category. That is, they bear very low risk because it is guaranteed by the government treasury itself. That is why after this prescribed time period, if I give back the T-bill, I will get my money. That is mentioned as a face value in the bill. So that is discounted bill that we have seen. So there may be a question on what is a discounted bill. So discounted bill, the face value is arrived at the end of the period. The face value is not taken as a initial benchmark but as the end benchmark of the payment or the process, that financial transaction, whatever is involved. So T-bills are low risk and highly secured. Next comes the commercial bills. It is same thing, but these are issued by industries or traders in the market. They will issue this commercial bill. Example, say suppose I will sell 100 kg of onion. From 3 months from now, I will sell it at a rupees 15. So I am seller, there will be a buyer. So what seller thinks is this price will come down less than 15. That is why he is ready to sell it at 15 after 3 months. And what will buyer think? Buyer will think that this will go even lesser than that. So that is why this guy is ready to sell, and he thinks it is going to become more than that. That is why he is ready to buy. This guy is ready to sell because he thinks this price is going to fall to 12, 13 or whatever. This guy thinks this price is going to touch 17 or 18 rupees. So he is ready to buy, he is ready to sell. They will make a agreement. That itself is a commercial bill. These are issued by industry or traders and they are accepted by banks in India. Same like T-bills, when you need liquidity. Say suppose 3 months. The underlying value is how much? It is 1500. Say suppose within 3 months I needed this liquidity. So I will go to the bank, I will put this commercial bill as a collateral or something, and I will take money from the bank, and ultimately the money, this money will be paid to him by the bank. This will be delivered by him at the end of this stipulated date. When he gives this agreement to the bank, it means that he is ready to give that 100 kg of onion to the bank. That is the matter. So bank can trade it off at whatever the price. Otherwise, he can again buy it back. He may again manage some liquidity and he will again take it, because he is of the opinion that this will be coming down. So imagine this in huge volume. There can be steel, there can be aluminum, there can be any raw material here, any vegetables, any fruits, anything. So that is a commercial bill. They are basically unsecured and high risk because they are not guaranteed by government. It is private individual or some industry or a trader that guarantees, and there may be chances that this agreement can be defaulted. So that is why it is unsecured and high risk, but it involves a lot of speculation, because there is somebody who is believing that the prices are going up and somebody who believes that the same prices are going down. So these dynamic things will play a lot of bigger role in the whole economy when you account for so many things that are being traded. So these commercial bills are issued only for short term. It is 3 months, 6 months and max 1 year. That is why this is a money market instrument. These are the instruments that we have seen till now in money market. Next, third instrument is repo market. Don't get confused between repo rate and other concepts that we will be looking in the banking chapter. This is repo market. Remember only two things if there is a question on exact repo market. It is collateralized short term lending and borrowing in the financial markets. That there will be a collateral for some money that you are borrowing from the markets, that you will pledge some land or a house or some property or an asset as a collateral, and you will take the money only for short term, 3 months, 6 months, 9 months, max 1 year. That is repo market. So if there is a question on repo market, these two words are important, and if these two words are there, that is the answer. It is short term and collateralized. In commercial bill, the collateral itself is the bill, and it's a process that banks accept it, other individuals accept it. That is why they are tradable. In this repo market, they are repo market instruments, where you will put some collateral and you will take money, or you will borrow money and you will lend money in short term. That is repo market. That is the third money market instrument that we have seen. The next money market instrument is the certificate of deposit. So there will be a deposit that is maintained by individuals with the banks, and banks with the RBI, and banks with other banks, RBI with other banks. So that is the kind of deposit that we are talking. Say for example, I have 10 lakh rupees in cash with me. I have deposited it in a bank in a form of fixed deposit. Say bank will say after 1 year, along with whatever interest rate, I will pay you some whatever amount, it will say, including the interest. What I will say, for this deposit, the bank will issue a certificate of deposit saying that I have the deposit of 10 lakh with me, and after 1 year, I will be ready to pay this much amount along with this interest for that particular deposit. So within 1 year, what happens? I get liquidity requirement. I want cash. What I will do? I will take the certificate of deposit and go to another bank. I will not withdraw this itself, but I will trade it with another bank, or somebody will buy it for me, and I will be ready to sell it at 9.5, 9.6, 9.7, 9.8, whatever it is in the negotiation in the market. I will exchange that certificate of deposit for liquidity in the markets. So these are accepted by the banks, these are also accepted by other individuals. At the end of this period, whoever is holding this certificate of deposit in their name, for them the bank will pay this much amount, that is 10.2 lakhs or whatever the accumulated interest, it will add to it and it will pay. This is certificate of deposit, that is the next money market instrument. These are all instruments through which people lend and borrow money in the financial markets. Financial transactions means what? Buying and selling. So if you do the same for money, it is borrowing and lending, that is giving loans and paying interest or EMI. That is this financial market instruments through which you can actually do all these financial transactions of short term, that is up to 1 year. Next is a commercial paper. It is something similar to commercial bill only, but these are issued by the corporate companies, MNCs, other big companies which have goodwill in the public. They will raise some funds from the public. Same like T-bills concept, they will issue, say suppose a 10 lakh. If the commercial paper is worth 10 lakh, somebody will buy in the public. It could be 1 people or it could be 10 people or whatever, they will sell it to them. So at the end of 1 year, along with the accrued interest, I will pay whatever this much amount the interest I will say. That is the company will say. So this commercial paper I will take, I will buy, I would have given 10 lakh and I will get this much after 1 year as interest. But within this 1 year, I need liquidity. So what I will do, I will go and trade this commercial paper in the banks or financial institutions or other individuals. So whoever holds that commercial paper at the end of this term period, they will get this much amount from this particular company that issued that commercial paper. It is basically unsecured because it is issued by the private companies or the MNCs. There is no guarantee, but only few companies with great goodwill in the public, they issue commercial papers like Tech Mahindra, Infosys, TCS. These are big corporates which also issue commercial paper to fulfill their short-term financial requirements, that is up to 1 year. This is the another money market instrument which is very important. The corporate sector uses this. So these are the money market instruments that we have looked into. Next we will look into the second type, that is capital markets. These are the second type of financial markets that we are looking at, and it is generally in the form of assets, that is securities. So what is securities and what is securities market, we will be looking here. It is about these assets. Here the money is not in liquid form or in ready cash form. It is in the form of few assets, securities, which are dematerialized. You might have heard about demat account. So what is a demat account? It is a dematerialized account, that the money or the value in that account is not directly convertible into cash, but it is in the form of dematerial, that is Dcash, that is in the form of asset or securities. That is about capital markets, and it is generally long term. It is for long term capital raising, that you want to create value out of some productivity. By that you will try to raise the incomes and you will try to raise the size of economy itself. So it is something that is long term, where the huge money is being swung into markets, and in between or the short term liquidity crunches will be used through money market instruments, and capital markets are for long term creation of assets, creation of further capital, getting profits. That is the capital markets. What are capital markets and what are two types of capital markets? We will have a look. Capital markets are essentially divided into two: gilt-edged securities market and industrial securities markets. So it's not security market or it is not security markets, it is securities markets. So if it is a single market, singular, you will call securities market. If it is plural, it is securities markets. But it is never security market, it is securities. So what are securities? These are the instruments in this capital markets. As we have seen in money market, there are various instruments. The instruments in the capital markets are in the form of securities. That is what I told, that is dematerialized. They are in the form of assets, not liquid cash. That is two types of in the capital markets are gilt-edged securities markets and industrial securities markets. So what is gilt-edged securities market? It is government issued instruments. Government issued instruments, that is the government securities. And T-bills. Generally T-bills are issued only for a maximum of 1 year only. But government securities are issued for more than 1 year, 2 years, 3 years, 5, 10, 20, 30. So there are long term instruments also. So all those instruments issued by the government are under gilt-edged securities markets, government and semi-government. All government and semi-government sector securities markets will be dealt in gilt-edged securities markets. While other industries, all other private, corporate and all other industries in the economy are dealt under industrial securities markets. So what happens here in gilt-edged? The government will say, go RBI, you issue some bills and raise some funds for us. So if they are short term, it will do it in money market. If it is long term, they will do it in capital market based on the time and what kind of money that we are talking, whether it is liquid money or assets that we are talking about. Based on that, RBI will issue the government securities and raise the funds from public. This is gilt edge. All other industries and companies that you look in the share markets and shares, stock markets, stock exchanges, all those companies come under industrial securities markets. This is a basic division in capital markets. So we have seen gilt edge. Next is industrial securities markets. Industrial securities markets are divided into two types: primary and secondary. Means primary industrial securities markets and secondary industrial securities markets. These are divided into two again. You try to understand these concepts in this way so that it will be imprinted in your mind. You can easily remember which topic or under which heading this will come, under which subheading it will come. So what's happening? This capital market is under financial markets, and under capital markets we have primary and secondary. So if there is a question, so what is the basic difference between our primary and secondary markets? Or if there is a question on which of the following is correct, and the question is on these, so it is essentially regarding these both, and it is part of financial markets chapter. Then you will look into these features, and then based on that concept you will be able to answer the question. So what is primary securities markets is, it is the first stage of transaction of securities instruments. Whatever securities instruments are being used in capital securities market, if they are sold for the first time in the market, if they are sold and it is the first stage of transaction, it is primary securities markets. And all other further number of transactions, anytime this securities instrument is sold and bought again any number of times further, it is in secondary securities markets. This is the basic difference between primary and secondary securities markets. All the stock exchanges, stock exchange listed companies, daily buying and selling of shares and everything will happen in secondary securities markets. What happens here is, when they go for the first time, so how does a company go public? It is called IPO, initial public offering. So the company will think that, say for example, I'll just say there is a firm. So I'll put some money, there will be some shareholders and everything, and this firm is producing some goods. It is selling them and making profits. So what I will look to see is, I will want to expand this thing. I may be doing only for one region or one state, I want to do it for the whole country. So what I will do is, I will go public. Going public means it is raising the funds from the public. Public are ready to invest, but only in minute numbers, but in large volume. That is the point. If I sell, I'll make my company public and I'll sell shares worth 50 crore. I'll sell it to around 50 lakh people or 10 lakh people, 5 lakh people, 20 lakh people. So that is, I will divide them into shares. This is called equity. This is a major, one of the most important securities markets instrument, that is equity. When you divide the whole valuation and go public and you sell shares, that is equity. So when you sell it for the first time, it is called initial public offering. So you may divest only 20%, 30%, 25%. Then again you may go more public again. First, then we will only release for 50 crores. Next you will release for another 50 crores, like that. So you get funds from the people, you use it in your business, again do make the profits, and you will give them dividends. So what is a profit on an equity or a share? It is dividend that I will be ready to give it to the public back. So what I will do, I will raise the capital from the public funds, I will use it in my company. That is what going public means. Then it will be enlisted in the stock exchange of our country. This is the example we have taken to understand what the primary securities markets is, that is IPO. Whenever we say that a company is going public, it means that it is being enlisted in the stock exchange of that country and it is raising funds from the public, that is capital, to run their business, that is primary market. Other instruments in the primary market include FPO, follow on public offer. It means initial time, first time when you go to the public, it is initial public offering. After that, as I have told, initially you will go public with 50 crores, then again you release 50 crores. So it can be called as follow on public offering. That is, it is still going public, it is not 100% public. So still there will be stakes with the people which can be sold in the markets. That is FPO. Next is rights issues. So there will be partners who had established the business from the beginning. So they might have spent just more than money as a partnership. They might have spent their own hard work, entrepreneurship and other skills. So there will be few rights that will be attributed to them when the company is going public. So that is rights issues. Next is ESOP, that is employee stock option plans. Say suppose there is a company that is going public. So what it will do is, it will give all the employees few stocks, that is few shares it will give to the employees, its own employees, that is employee stock option plans. Whenever the company goes public, that these are all primary securities markets instruments. Let us get into few more instruments in the process, that is securities instruments. These are instruments in capital market. Don't forget, the first and the most important one is equity, that is shareholding. As I had explained in this, when the company is going public, it will divide this 50 crore and it will sell it to some lakhs of people. It will give few shares to each of them. So all the public will invest in it so that they will get dividends when the company earns profits through the money. So it is capital raising. One first main instrument is equity. So that is shareholding. Whenever company goes public, it gives shares to the public, that is equity. Second one is debt. It is the same process again, that there will be a company that it wants to go public, means it wants to raise capital funds from the public. So one option is to divide the valuation into equity and give shareholdings. Second option is you will directly take debt. So there will be bonds that are issued by that particular company. They are called bonds, or they are called debentures. Don't get confused among these terms. These are all the same. Debentures is nothing but a debt instrument. Whenever there is something called instrument or something, don't think it is complicated. It is a simple agreement. Here it is a bond or a debenture with an agreement that I am taking 10 lakhs from you as a debt. It is direct debt. It will be shown in the liabilities of the company balance sheet. That is debt. Directly appu techukovadam. That is debt. So in what form it is given is bonds or debentures. Debentures are also bonds only. Bond is some agreement. So what the agreement says is that I am raising 10 lakhs as a debt and I am the person who is giving that. So I will pay 10 lakhs to the company, and company will say after 1 year or 2 years, I will give you this much percent of interest and I will pay you, in the end I will pay you some extra interest. So almost all the bonds are discounted bonds only, like even in the debt instruments also, that they will be sold at 9.15 lakh or 9.2 lakh. And at the end of this term, this face value of 10 lakhs is achieved. That is discounted instruments. So these are the bonds. If I raise money like that in the direct form of debt as a liability, that is the second instrument, debt. So among these two, which is more crucial, or which is the more technical thing, is that it is debt. For the simple reason that if tomorrow my firm has defaulted any amount, or it is not able to run its business, so it will be liquidated, means all the assets of the firm will be converted into cash, and whosoever they are having liabilities, they will be paid. So bank will be paid. Then the holders of debt, these debt holders are the second most important people who will get the money when the company is liquidated. And the last preference is whom? Equity holders. The shareholders in the company are the ones who will get that after liquidation. If there is any amount left, that is distributed among shareholders, and if there is no amount left, nothing they will get. Just by holding an equity instrument, you will not get. So but debt is a liability in the balance sheet of the company. That is why when the company is liquidated, the debt holders will get their money eventually. So debt is more technical instrument. It is more common instrument, equity, because shareholding, it will be sold to 5 lakh people, 10 lakh people. Each share is only around 500 rupees, 1000 rupees, 100 rupees. So even some companies start their shares at 10 rupees. So they'll just convert this 10 rupees into 10 lakhs. That is 1 crore. They will raise 1 crore. They will give 10 lakh people shares. Each share is 10 rupees. If I hold, say, 10,000 shares, I would have spent 1 lakh. As the company is growing, using these funds, getting dividends and everything, tomorrow the value of that share, 10 rupees share, will go to 100 rupees. That is when I become wealthy. So it is in the form of asset. It is not direct cash or liquid money that is being used in all the capital markets, including equity, debt and everywhere. This is what is Demat account. If you get a question regarding what is Demat account, some of you may have heard, if you are investing, if you are buying equity, shareholders, Nifty, Sensex, we will see what everything is, mutual funds. If you are buying such instruments, then it is only possible through a Demat. What is the full form of Demat? Dematerialized. Materialized means cash or liquid cash. That is material matter that you are looking at. It is dematerialized, means it is in the asset form. It is not in liquid form or cash form, that is easily or readily used to be used as a liquid measure. These are the main two instruments, securities instruments in the capital markets. Third one is derivatives. Don't get confused between debt, debentures, derivatives and everything. I will explain clearly. Debt or debentures or bonds is the same. They are all debt instruments. If you get a word debenture, it means it is a debt instrument. But derivative is something different. Let us look into the concept of derivatives. The whole meaning is in its meaning of the word itself. That is, there will be an underlying value or an asset whose value is derived because of that asset. Say suppose I have 10-ton steel. So this 10-ton steel is from where the value of this derivative is derived. Means derivative is nothing but again one agreement. As we had seen in the example, when there is a seller and buyer ready. So it is also a form of derivative only. The underlying value of this product will give the value to the derivative, and it is nothing but a kind of agreement which is also accepted by the regulator of capital markets. Who is the regulator of capital markets in India? It is SEBI, Securities Exchange Board of India. We will look into SEBI, how it came into existence, what it will do, functions and everything soon. So it will approve these kind of derivatives. So as we had discussed in the example earlier, this is seller, there will be a buyer, and there will be a time period and a pre-decided price for which these goods will be sold at this after this stipulated time. So this is a kind of agreement that is made. That is nothing but a derivative. So whenever I don't have money, or I want to convert this asset into liquid form, or I want to convert this asset into another asset, so I will use these derivatives which are tradable, negotiable. What is the difference? Tradable means they can be exchanged in secondary markets. How many number of times? ఎన్ని సార్లైనా అమ్మొచ్చు కొనొచ్చు. So whenever I don't want this asset, I can sell it. Somebody is ready to buy. Where? It is in the secondary securities market. It is not initial. It is something that happens in the secondaries markets. So that is means tradable. Negotiable means the underlying value, as I had discussed in the example. Say suppose the underlying value is 10 lakhs, but I'll have to wait for 1 year to get that 10 lakh face value. So I will be ready to sell it at 9.5 lakh. I may have given 9.2 lakh in the beginning, but after 3 months I got requirement, or I don't want this, I don't think this asset is going to fetch me money, so I'll try to sell it off. After I get 9.5 lakh, I'll invest in this in some other asset which I think will benefit me. This is what that means. So this price which you arrive at based on this value, that is negotiable. Means if I am a buyer, I can say 9.5. Somebody else will come and say 9.4. So he will see whoever gives the max, he will give it to me 9.5. So that is negotiable. That price can be negotiated between the parties, buyer and the seller. That is what negotiable means. So these are derivatives. There are 3 types of derivatives contracts, or as we have seen, these kind of agreements I have told you, they are also called contracts. Let us look into the 3 types of contracts, or the 3 types of derivatives which are existing. We'll have to understand a little concept here in order to have an understanding of 3 types of contracts and how they have actually emerged. Say suppose there is a seller. As I have told earlier, an example like earlier only, there is a seller and there is a buyer, and there will be a agreement or contract. These are the top 3 types of contracts that we are speaking, and the underlying value will be this good at whatever price the seller is ready to sell after a stipulated time period. It can be 3, 6, 9, 12 months, like that. So there is somebody who is ready to buy, who thinks that this price is going to be more than 100 rupees after this stipulated time period, and he is ready to buy. And he thinks that after stipulated time period, the price is going to be less than 100, and he will be making profit if he sells at 100, whatever the quantity that he will be selling. So there will be an agreement or contract made. Now try to understand this concept and think where there will be a gap, or if there is a gap, where the gap is. So I'll tell you, it is the risk. What is the risk for seller? That the price may go higher as the buyer is expecting. And what is the risk for buyer? The price may go lower than this. So he will be at a loss if he buys at this price. So this is what seller thinks actually, but it is a risk if opposite happens, that the price goes higher, the seller is at risk, and if the price goes lower, the buyer is at risk. And either of them can at any point of time, or at this point of time, can say that no, I will not execute this, because if it goes higher, if it is say 150 rupees, the seller is at loss. That is why he will say no. That is a risk. And if the price goes lower, buyer will say I will not buy it. The seller will be at loss. So these are the risks associated in this concept. So this is the gap areas which this 3 types of contracts actually fill in. It's very simple that if this agreement or contract is stated to be legally binding, where it is legally binding in futures contracts, that this agreement should be executed. Whoever will be at the loss doesn't matter. It doesn't matter, this should be executed, and it will be an obligation for either of the parties. Why? Because even if they don't like, they will have to execute this agreement, because it is legally binding which means that the either of the parties can drag the other party to the court over forcing them to execute this agreement. That is futures contracts. And forwards contracts is the other extreme, where it is just a right but not an obligation. Here in forwards contracts, either of the party can say no, it will not be executed. It doesn't matter if it is the seller or the buyer. If either of the parties says no, it cannot be executed because it is a loss to me, it cannot be executed. That is forwards contracts, and it is not legally binding. This is legally binding. Means even if somebody is at loss, they will have to execute the agreement. And options contracts is something in between these two extremes. That is two types, call option and put option. Call option contracts, put option contracts. These are studied in depth for like SEBI examination. If somebody attempts SEBI examination for grade A managers, there will be a separate paper for securities markets. There very deeply these concepts will be studied, but for any other competitive examinations, it is essential to know till here that what are these two options and what is that. Example, say suppose seller says I will not sell, but buyer can say you will have to sell, that I have right to buy. So he will call for right to buy in the call option. So in the call option, the buyer will say execute it, because the prices may have gone higher and seller will be at loss if this executes. But if it is a call options contracts and buyer says I am calling for this contract to executed, seller will have to do irrespective of whether he likes it or not. That is call options contracts. And put is reverse, right to sell. The seller says no, you will have to buy this because the prices have gone lower as this guy has speculated, and he will be making profit if the agreement is executed. And even if the buyer says no, he will have to buy it. So that is put options contracts. So in a nutshell, this is this concept, the risk associated with this concept, and the two extremes. One is legally binding, other is right but not an obligation, and in between we have call and put option. Just remember this concept, you will be able to answer any type of question in this corner. Remember the concept, try to understand the concept. So in the call, we will say the call option, it is right to buy, the buyer will have the right. In the put option, the seller will have the right. So there will be 4 options tomorrow. So under put option, so buyer has the right, seller has the right, buyer is obligated, seller is obligated. So if it is put option, it is right to sell. So the buyer is obligated and seller has the right. That is the correct option. If you understand the concept, it will be very, very easy and you can deduce the answer then and there. These are the type of the questions that are generally expected in prelims. So understand the concept and have an idea on types of derivatives. That is 3 types of contracts: futures, options and forwards. In options, it already says options. It means there are 2 options. What are those? Call option, put option. Call means right to buy, put means right to sell. This you remember, this concept will be done, and any question in this concept you will be able to answer. So I hope I am clear with these concepts, the capital market and then securities instruments that we are talking about. So let's get into the next securities instruments. Stock markets in India. All the capital markets that we see, the front face of all that markets is the stock exchanges. So the oldest stock exchange in India is Bombay Stock Exchange. It was established in 1875. BSE was corporatized, means BSE Limited. It was made BSE Limited in 2005. Until then it was only Bombay Stock Exchange. It was corporatized, means it is BSE Limited since 2005. And next oldest is Ahmedabad Stock Exchange. It was established in 1894. It was established especially for dealing of textiles and textile mills. Shares are being actively sold and bought on Ahmedabad Stock Exchange. And next is Calcutta Stock Exchange. When was this established? It is 1908. Established in 1908. It is also one of the oldest stock exchanges. So what happened? Eventually BSE became the major stock exchanges of the country till 1992, when NSE was established. What is NSE? National Stock Exchange. It is backed by the financial institutions. The development financial institutions that we have seen, it is backed by those financial institutions at the behest of Government of India. Means it is Government of India's financial institutions only that have come forward and established National Stock Exchange, and it came into operation in 1993-94, and it became the largest stock exchange of the country in 1995. That is the history of National Stock Exchange. Although Bombay Stock Exchange was by then existing for almost more than 100 years, NSE had come into existence, and within 1.5 years it has become the largest stock exchange of the country since 1995. That is NSE. Next, what are the major indices or the barometers in these share markets or the stock exchanges? There are two types of transactions that take place in stock exchanges. One is investment transactions. They are long term. Then speculative transactions, which are short term. As we see in the real time stock exchanges, the spot trading, intraday trading. So these are all the short term trading within the capital markets. So that is the speculative transactions. They only speculate the prices and they doesn't fix the long term value of those goods and services that are created in our economic markets through these investments, or through the money that is being pumped through speculative investments. But investment transactions, it is long term. They are at creating assets, in creating value. So these are the two types of transactions that take place in stock exchanges. Next is the major indices. We all know, we have been hearing these words since we were kids in the news channels. It is BSE Sensex and Nifty, NSE Nifty. These are the two major indices of the Indian capital markets. And which among them is called the barometer of Indian capital markets? It is Sensex. It is the barometer of Indian capital markets. So what does this mean? It means there will be the top 30 market capitalized shares in the stock exchange. They will be created into one bunch or one index. That is sensitive index. What is the meaning of Sensex? Sensex is 30. Sensex 30. It is sensitive index, means the top 30 MCAP. What is MCAP? Market capitalization shares or the company shares will be bunched together into one index, and the movement of those shares is seen as the underlying trends will be watched or will be observed through that index or that particular Sensex. So that is 30 companies, the top 30. Nifty is top 50. It is very easy to remember. Remember Nifty 50. Sensex 30. So it is same. This is NSEs. This is BSE. So we have one each from two major stock exchanges in our country, BSE Sensex and NSE Nifty. So these are the major indices in the stock exchange. This is the top 50 MCAP companies in the stock exchange. The movement of those will be seen as the whole sentiment of the markets. We keep seeing Nifty fell down 100 points or Sensex collapsed 2,500 points, or say this much percentage it has come down, because the markets were markets are not optimistic. What is it? There are two types of players, that is bears and bulls. Bulls are the one that are positive, optimistic, that the markets will keep growing and they will keep giving good benefits. Bears are the guys who think that markets are not going well, they are not optimistic thinking, and they are ready to sell more, they are ready to buy more. So they are bulls, they are bears. These are two types of people or public we can segregate in the securities markets, in stock exchanges. That is what they say, the markets were a bearish look today. Means people are selling off, they are not looking in buying and making the markets bigger, they are looking to sell off. So market is bullish, means more optimistic, positive markets or the trends are being observed in the market. It is what that means. This is about the major indices in the stock exchanges. Next up, we will be looking at the commodity trading. This already we have seen through those examples, in the buyer and seller examples that we have seen previously. That is nothing but the commodity trading. If there are goods, only goods, not services, then it is commodity trading. There are various dedicated stock exchanges or commodity stock exchanges also available in India, and in total in the country actually there are now presently more than 25 stock exchanges actually. Some of them are dedicated to only particular sector, like in, as we have seen, the Kolkata Stock Exchange, while established in this is mainly for jute. It is for jute companies to raise money from the public. It was mainly used. Ahmedabad, textiles. In that way, there are more than 25 stock exchanges in our country right now, and there are dedicated commodity trading stock exchanges also available in the country. So as we have seen, Forward Markets Commission used to regulate this commodity trading or the futures tradings and forwards tradings earlier till 2015. So in 2015 it was merged with SEBI. Now who take care of this commodity trading and other forwards contracts, future contracts and everything? It is SEBI. Earlier it used to be FMC, that is Forwards Markets Commission. It was a regulatory body. Now it is merged with SEBI. Now SEBI under overlooks the whole commodity trading aspect also separately by merging the Forwards Markets Commission. Don't get confused with Forwards Market Commission. It is a old concept, and it is nothing but it is the one which was regulating the commodity trading, but it was merged with SEBI in 2015. Don't forget this. Keep following, keep updating yourself with the latest updates in the capital markets, like look for any new kinds of instruments that you come across. Like in debentures, there will be different types of redeemable, non-redeemable, convertible, partially convertible, fully convertible, and little technical things. If one prepares for SEBI in detail, they will be easily understanding. But just in case, if the papers are taking that trend and they are coming more in the newspapers and everything, try to pick those words. They are anyway or somehow linked to these concepts that we covered in this whole chapter. You will never miss anything outside this concept. So, try to pick them on dynamic resources, that is newspapers, magazines. look for good blogs or good articles that you find, like say Mint writes good articles, Economic Times writes good, very good articles. So go read them, the free ones that are available in the internet. Try to pick good words from those articles. They are really good and they will improve your grip on this subject. So don't stop doing that, or don't even start by not doing this dynamic and all these things. Otherwise these concepts will be of no use, and within 2-3 months you will forget all these concepts if you don't brush yourself through the dynamic resources. You will have to keep them updated. So have a look on wherever the SEBI names come in the newspapers, why SEBI's name is coming here. So it means SEBI is also overlooking these things, or SEBI also does this. So that you will have an idea on the functions of SEBI. So ultimately when you take a standard book and read, there will be functions written, have a look at those also. Otherwise go to the official website of SEBI, and in that website itself try to note down few keywords regarding the functions of SEBI. Then functions of RBI. Functions of RBI we will be covering in the upcoming chapter, banking chapter, very detailedly, but still you can have an idea. These things are all under the purview of RBI. These things are all under the purview of SEBI and etc. So if you don't keep yourself updated, these concepts are of no use, that you will feel, oh, I know something new, but if you don't apply it, or if you don't keep them brushed up, it will get rusted anyways. Don't do that. Keep updating yourself with the latest dynamic parts from the dynamic resources that we have earlier discussed. Let's get into the next chapter in our economy module, on one of the most important chapters, that is money and banking. Money and banking and financial markets have to be seen together only, more or less. So some people teach money and banking before and this later or whatever, but this is totally like one total concepts of the whole financial markets and how money. If you get into the details of money market, into the detail, that will be money and banking chapter. So let us look into that, what money is, what kinds of money are there, who will be regulating, how they will be regulating, what and everything, the concepts associated with that we will be covering in money and banking chapter. So let us dwell fast into this chapter now. Let us look at the definition of something which is very important, which is called fiat money. What is fiat money? Say suppose I go to some place in India and I'll give them US dollars and asking them to buy me some goods and services. So I go to some random place, it is not a foreign exchange, or it is not RBI that I am going to. So if that is not a legal tender in this country, so fiat money is something that is a legal tender, which is accepted within those territory, that whatever country designates one currency as a legal tender, it should be used as the currency within that country, and it should be used as a medium of exchange with the other currencies outside the world, with the outside world. That is what fiat money means. And they will have to pay all their debts, all the liabilities they will have to be paying in this legal tender or in this currency only. What is the example of fiat money? Indian rupee, US dollar. This is all fiat money. Means it is authenticated, it is a legal tender, it is accepted by, acknowledged by some country or some economy is legally issuing that currency. That is what fiat money means. Don't forget this. This is one of the basic things. So that is why I am defining it here in the money and banking chapter. It is fiat money, that is legal tender. Next, what is the total money, or what is the total money supply that is in the economy? It needs to be calculated. Or what are the types of money that is actually in the money supply or economic supply? So there are majorly two types of money. First one is the currency. Currency means all the notes, coins and other mediums which are tangible, which are physically available. And the second one is bank money. So what is bank money? It is very simple. You receive a message saying that your account is credited with rupees 54,000 as a salary. But is that 50,000 rupees in currency with you in your hand? No, that is what is bank money. That is the money that is parked in the banks. Equal to that, RBI will be maintaining some minimum reserves and other things. But this is what? This is something that is printed and it is legally issued. And it is in the circulation, that is currency in circulation. But bank money is something that is in the banks. It can be with other banks or it can be with the bank of the banks, that is RBI, that is bank money. These are majorly two types of money. Don't get confused with currency in circulation and money with the banks. So I have, say suppose in my account right now 2,000 or 20,000 rupees, say suppose. Say suppose I have rupees 20,000 in my account. But out of this 20,000, I only have 1,500 in cash form in my wallet. So in this 1,500 is currency and the remaining 15,000 is whatever 18,500 is bank money. I use cards, I pay through Paytm, I do any other means of transaction and I can send it to another account. So that is bank money. This is currency in circulation. So don't get confused between these two. These are kind of basic things that needs to be covered.